Welcome, you curious minds, to another deep dive.
Hello there.
Today, we're taking a really comprehensive look at the Reserve Bank of India's activity for the entire month of June 2025.
Yeah, June was quite packed, wasn't it?
It really was. It's
Oh.
a period full of insights covering everything from monetary policy shifts to, detailed banking regulations and those key economic indicators we always watch.
We truly have a lot to unpack. The RBI has been exceptionally active across many fronts, really showcasing its crucial, multifaceted role in India's financial ecosystem.
Right.
Our mission today really is to distill the most important nuggets of knowledge from all these announcements and help you understand not just what happened, but why it truly matters to your financial world.
Exactly. So what does all of this signal for the broader economy, for businesses large and small, and maybe most importantly for your own financial life? Let's jump right in, starting with the announcements from the first half of June. Okay, first up, something a little different, but I think incredibly insightful for anyone interested in the institutions that shape our world. The RBI has launched a documentary series.
That's right. Yeah, a bit unusual but interesting. The Reserve Bank of India, they've collaborated with GeoHotstar and released a 5-part documentary series. It's called RBI Unlocked, Beyond the Rupee.
Okay.
And it's produced by Chalkboard Entertainment.
So what's the driving force behind a project like this? Why now?
Well, this series was commissioned by the RBI itself. The idea is to visually chronicle its, 90-year history.
90 years.
Yeah. And a key objective, really, is to significantly boost public awareness about its diverse functions and roles. A lot of what they do stays kind of behind the scenes for the average person.
True.
So it's a pretty powerful way to engage with the public, trying to make a somewhat, let's say, abstract institution a bit more relatable.
A visual journey into the heart of India's central bank.
Yeah, that sounds like a fantastic way to maybe demystify some complex financial concepts for people.
Hopefully.
Okay, let's turn our attention to something that impacts, well, a really fundamental aspect of financial inclusion: microfinance. The RBI has revised the qualifying assets criteria for NBFC-MFIs, that's non-banking financial companies, microfinance institutions.
Right. So to set the stage a bit, the master direction from 2022, the one on the regulatory framework for microfinance loans, that initially set these criteria.
Okay.
And their main aim was to ensure these NBFC MFIs stayed focused on microfinance lending, basically by requiring a specific percentage of their total assets to be classed as qualifying assets.
Right, keeping them focused on that core mission. And what are the key adjustments we're seeing now?
So upon review, the RBI has made several important revisions. First, the definition of qualifying assets for these NBFC MFIs is now explicitly aligned with microfinance loans.
Which means it's defined as a collateral-free loan to a household with an annual income up to 300,000.
Okay.
And they define a household very specifically, an individual family unit, so husband, wife, and their unmarried children.
Got it. So a much clearer, more precise definition there. What other significant changes are there?
Well, crucially, NBFC MFIs must now maintain at least 60% of their total assets as qualifying assets. That's excluding intangibles, and it has to be on an ongoing basis.
60%. Wasn't it higher before?
Yes, exactly. This marks a substantial reduction from the previous 75% requirement.
That is a significant shift. What are the consequences if they, dip below this 60% threshold?
Well, if an NBFC MFI falls short of this 60% for 4 consecutive quarters,
Okay.
then they're required to submit a remediation plan to the RBI, and the RBI will review that plan.
It feels like there's a broader strategy behind this adjustment, giving them a bit more breathing room.
Absolutely. I think this move is designed to, 1, enhance the lender's credit risk profiles, and 2, give them more flexibility to address a wider range of borrower needs.
Right.
It's about empowering them to maybe diversify a little, but still keeping that core microfinance focus.
Makes sense.
And there's another piece here. For other NBFCs, the ones not qualifying as NBFC MFIs, the maximum limit on microfinance loans they can actually extend has been raised.
Okay.
It goes from 10% up to 25% of their total assets.
Oh, interesting.
Yeah. And the master direction document will be updated to reflect all these changes.
So more operational flexibility for the microfinance lenders themselves, which could potentially, maybe, translate into more diverse or tailored lending options for borrowers. How do you see this impacting the overall financial inclusion landscape in India?
Well, potentially it allows MFIs to perhaps offer slightly larger loans or different types of products alongside the core microfinance, maybe serving a slightly broader segment or offering more holistic solutions. The increase for other NBFCs also widens the pool of lenders offering microfinance. So, yeah, it could enhance inclusion, but the key will be ensuring that the original focus on serving the underserved isn't diluted.
Right. Now, for a major announcement, this one has implications for pretty much every individual and business out there. The Monetary Policy Committee, the MPC, has released its June statement.
Yes, the big one. So following a thorough assessment of the whole macroeconomic situation, the MPC decided to reduce the policy repo rate by 50 basis points, bringing it down to 5.50% effective immediately.
Wow, 50 basis points. That's a substantial rate cut. What are the immediate ripple effects of that decision across the banking system?
Well, as a direct consequence, the standing deposit facility rate, the SDF rate, that's now adjusted down to 5.25%. And both the marginal standing facility, or MSF rate, and the bank rate, they both stand adjusted to 5.75%. Everything moves in tandem.
Got it. And what about the overall monetary policy stance? Did that change?
Yes, it did. The stance has transitioned to as accommodative, and now it's moved to neutral.
Neutral, okay.
And these decisions, they stressed, are all meticulously aligned with achieving that medium-term CPI inflation target, the 4% plus or minus 2% band, but also, importantly, supporting economic growth.
So a clear signal from the RBI there, balancing inflation and growth. What do their latest economic projections look like now?
Well, real GDP growth for the fiscal year 2025-26, that's projected at 6.5%.
Okay.
And significantly, the CPI inflation forecast for the same year, FY 25-26, is projected lower. It's now at 3.7%. That's down from the earlier 4% projection.
Lower inflation forecast. That's key.
It really is. This downward revision suggests they have growing confidence in the inflation outlook.
Beyond the rates, what other major decisions did the MPC make that will have a broad impact?
Well, another big move was the decision to reduce the cash reserve ratio, the CRR, for all banks.
Oh, okay. By how much?
By 100 basis points in total. But it's not all at once. It'll be implemented in 4 equal tranches of 25 basis points each.
The staggered.
Exactly. Yeah. This will ultimately bring the CRR down to 3.0% of net demand and time liabilities, the NDTL.
And when do these tranches kick in?
They're set to be effective from the fortnights beginning September 6th, then October 4th, November 1st, and finally November 29th, 2025.
Okay, spread out over a few months. And what's the anticipated effect of this significant CRR cut? What does it do?
Well, the main effect is injecting liquidity. This reduction is expected to release a substantial amount of primary liquidity, they estimate around 2.5 lakh crore, into the banking system by December 2025.
2.5 lakh crore. That's a massive injection of funds into the system. Connecting this to the bigger picture, what does this aggressive move, combined with a rate cut, signal for the economy, especially regarding growth?
It clearly suggests a very strong commitment to supporting growth, doesn't it?
Right.
And it's coupled with that confidence we mentioned in the inflation trajectory.
Right.
We've seen, the data showed overall non-food bank credit grew by 9.8% year-on-year as of late May, which sounds okay, but it's actually a deceleration from 16.2% year prior.
Yeah, it's quite a slowdown.
Exactly. So the MPC's moves look like a direct response to that moderation. They're designed to stimulate lending and economic activity.
Makes sense.
And it's probably also reassuring for them to note India's foreign exchange reserves stood pretty robustly at US $691.5 billion as of May 30th. That's enough to fund over 11 months of goods imports.
That's a strong buffer.
Yeah.
So the big question for many listeners, how quickly will these rate cuts and the CRR cut translate into lower borrowing costs for consumers and businesses, and how might that stimulate demand?
That's always the key question, isn't it? The transmission. Well, it's not instantaneous. It depends on individual bank policies, their own cost of funds, market competition.
Right.
But typically, such strong signals from the RBI do lead to a noticeable drop in lending rates. You'd expect to see it filter through over, say, the next 1 to 2 quarters.
So maybe some relief on EMIs and lower costs for business investment down the line.
That's the intention. It should nudge consumption and investment, hopefully boosting that growth figure while inflation stays within their comfort zone.
Okay, let's move to a very specific but still strategically important sector, shipping. The RBI announced a relaxation for the import of shipping vessels. What's this about?
Right. So the background here involves the Master Direction on Import of Goods and Services, MD Imports.
Okay.
That typically mandates additional safeguards. Think bank guarantees or an unconditional irrevocable standby letter of credit,
Yeah.
an SBLC, especially for high-value advance payments. Things like large capital goods, including shipping vessels.
Right, those big-ticket items. And what exactly is this relaxation they've announced?
Well, basically to promote ease of doing business and maybe acknowledging the unique financial structures in the shipping sector. Importers are now allowed to make advance remittances for importing shipping vessels up to USD 50 million without needing that bank guarantee or SBLC.
$50 million without the guarantee. That seems like a big deal.
It is. It simplifies things quite a bit for them. And this directive comes under FEMA, the Foreign Exchange Management Act, Sections 10.4 and 11.1.
So essentially, streamlining a major financial transaction for a key industry should reduce some friction and cost for them.
Precisely. That's the aim.
Okay. And speaking of how banks operate, let's look at how they manage their large exposures. There's an amendment to the list of exempted exposures under the Large Exposures Framework, or LEF.
Yes. So previously, deposits that banks held with NABARD, specifically because they had shortfalls in meeting their priority sector lending, or PSL, targets, those deposits were excluded from the LEF limits.
Right, so those mandatory contributions didn't get caught up in exposure cap.
Exactly. It was a specific carve-out.
So what's new in this amendment? Who else is now included in this exemption?
Well, the RBI has broadened this list. So in addition to NABARD, this exemption will now also extend to contributions made by scheduled commercial banks to the National Housing Bank, NHB, Small Industries Development Bank of India, MUDRA Ltd, and also any other entity that the RBI might specify later.
Okay, quite a few more institutions now.
Yes, but the condition remains the same. These contributions must still be linked directly to PSL target shortfalls to qualify for the exemption.
Right. So connecting this to the bigger picture, what's the practical implication for the banks? How does this help them?
Well, this amendment, which is effective immediately, by the way, it just provides banks with greater operational flexibility in how they fulfill their priority sector obligations. It ensures these crucial contributions, which, serve a vital social and economic purpose, aren't constrained by those large exposure limits.
And just to remind everyone, what constitutes a large exposure?
Good point. A large exposure under the framework is when a bank's total exposure to a single counterparty or a group of connected counterparties is equal to or above 10% of its Tier 1 capital.
Got it. Thanks for clarifying. Staying on this theme of priority sector lending, there's also an important development concerning urban cooperative banks, UCBs, and specifically their non-achievement of PSL targets.
Right. So current regulations for UCBs, they set out prudential exposure limits. It's typically 15% of Tier I capital for a single borrower and 25% for a group of connected borrowers.
Okay.
Now, for banks in general, excluding those UCBs under specific restrictions, falling short of PSL targets usually means they have to contribute allocated amounts to funds with NABARD, NHB, SIDI or MUDR Ltd.
And there was a penalty involved.
Yes, usually a penalty interest rate applies for those sub-target shortfalls. There were clear financial consequences.
So what's the specific change for UCBs now regarding these contributions?
Well, after a review, the RBI has decided to exempt the contributions made by UCBs towards these eligible funds, NABARD, NHB, SIBI, MJRA, Ltd, etc., from being included in the calculation of their aggregate exposure for prudential limits.
Okay. So if the contribution is due to a PSL shortfall.
Exactly. If it's specifically due to PSL target shortfalls, it won't count towards their overall exposure limits.
So that could certainly provide some relief for UCBs, freeing up their exposure capacity a bit.
Precisely. It gives them a bit more headroom. However, and this is an interesting point, for capital adequacy purposes,
Yes.
these contributions will still attract a risk weight of 100%. They fall into the category of all other assets.
Okay, so relief on exposure limits, but not on capital requirements for those amounts.
Correct. And this instruction is also effective immediately. We should also remember UCBs have their own specific minimum capital to risk-weighted assets ratio, CRAR, requirements. These vary by tier, ranging from 9% for Tier 1 UCBs up to a phased 12% for Tiers 2-4 by March 31st, 2026.
It raises an interesting question, doesn't it? How will this particular decision balance the need to, support UCBs in meeting their social objectives of priority sector lending with the absolute imperative of ensuring their ongoing financial health and stability?
It's a delicate balance. Exempting from exposure limits helps them channel funds without hitting prudential caps, supporting PSL. But keeping the 100% risk weight ensures they still hold adequate capital against those funds, maintaining financial prudence, is trying to achieve both goals.
Okay, let's shift gears slightly to broader banking regulations,
Yeah.
specifically Basel III, capital regulations, and the role of external credit assessment institutions, or ECAIs.
Right. Basel III, as you know, it's the global regulatory framework, really designed to strengthen bank capital requirements, focusing heavily on improving risk management and overall resilience of banks.
Hmm.
And a core part of this involves assigning risk weights to banks' claims,
Yeah.
basically their loans and investments, based on external credit ratings. This is crucial for calculating capital adequacy.
And this update concerns one specific rating agency.
Yes. Until now, ratings from Brickwork Ratings India Private Limited, or BRAPL, could be used by banks, but there were certain specified restrictions placed on their usage.
Okay. And what's the update now regarding those BRIPL ratings?
Well, following a comprehensive review, the RBI has decided to remove all previously imposed restrictions and limits on banks using BRIPL ratings for risk-weighting their claims for capital adequacy purposes.
All restrictions removed, so essentially putting them on par with other recognized EKIs in this context.
That seems to be the implication. It signals greater trust and certainly provides more flexibility for banks when incorporating BRIPL ratings into their risk assessments and capital calculations.
Right. And finally, for this first half of June, something that could very directly affect you, the listener, especially if you have an old bank account maybe you haven't touched in a while. The RBI has revised instructions regarding inoperative accounts and unclaimed deposits.
Yes, this is quite consumer-focused. So the existing instructions, they mandate that any deposit account that hasn't been operated for 10 years or more.
10 years?
Yes, 10 years. Or any amount that remains unclaimed for that period. It must be transferred to the Depositor Education and Awareness Fund, the DEA fund, which is maintained by the RBI.
Okay. And banks already had some requirements for helping people reactivate these.
They did. Banks were already required to offer KYC updation for activation at all branches,
Yeah.
including non-home branches, and also through VCIP, the Video Customer Identification Process, if the bank provided that facility. Business correspondents, BCs, were also meant to assist.
So what's the new amendment brought in by these revised instructions, Amendment 2025? What makes it easier for consumers now?
Well, the key amendments, and these are effective immediately, are really designed to significantly enhance accessibility and efficiency for the customer.
How so?
Firstly, banks are now required, it's mandatory, to make the facility for KYC updation for activating these inoperative accounts and unclaimed deposits available at all branches, including non-home branches. No more being told you have to go back to your original branch.
That's a big improvement itself. And the VCIP, you said that was if available before.
Exactly. And this is a significant addition. Banks must now provide the VCIP facility for KYC updation.
Must provide it.
Yes. This allows customers to complete their verification remotely, via a video call. It ensures far greater convenience and really overcomes those geographical barriers. Think about people who've moved cities or even countries.
Absolutely. That sounds like a potential game changer for many.
It really does. And additionally, banks are now explicitly allowed to utilize their authorized business correspondents, the BCs, to assist in activating these accounts. This aligns fully with the existing Master Direction on KYC from 2016.
This feels like a big win for consumers, especially maybe those in more remote areas or who moved. It just makes it much, much easier to track down and reclaim their own funds.
Definitely. Removing hurdles, leveraging technology like VCIP using the BC network, it all points towards making the process much more customer-friendly.
Okay, we certainly covered a lot in the first half of June, from those major monetary policy shifts aimed at growth and inflation control to fine-tuning regulations for microfinance, UCBs, large exposures.
And consumer-focused changes like the unclaimed deposits rules.
Exactly. Now, let's pivot to the second half of the month. The RBI didn't slow down, did they? They continued their active role, releasing crucial data and introducing even more significant regulatory adjustments.
No, they kept going. The latter half of June offers further critical insights, particularly into the financial health of the nation through credit data, and also ongoing efforts to refine market operations and various credit frameworks. It really provides a complete picture of the RBI's focus during the month.
All right, starting the second half with a look at where bank credit is actually flowing. The RBI released its data on the sectoral deployment of bank credit for May 2025.
Yes, this data gives us a snapshot. It's compiled from figures provided by 41 selected scheduled commercial banks, which, collectively represent about 95% of total non-food credit. So it's pretty comprehensive.
And it compares year-on-year trends.
That's right. It looks at growth compared to the same period last year to highlight the trends.
So what's the headline from this data? What did it reveal?
Well, the overall non-food bank credit, it grew by 9.8% year-on-year as of May 30th, 2025.
9.8%.
Yeah. Now, what's particularly notable here, and connects back to the MPC's actions, is that this represents a significant deceleration. It's down from 16.2% growth recorded in the same period just 1 year prior.
Wow. Okay. 16.2 down to 9.8. That is a slowdown. And how does that deceleration break down across the different sectors? Was it broad-based?
It seems quite broad-based, yes. Credit to agriculture and allied activities, that grew by 7.5% year-on-year. But that's a substantial decline from 21.6% growth last year.
Huge drop.
Yeah. The industrial sector recorded 4.9% year-on-year growth, down from 8.9%.
Okay.
Growth in credit to the services sector also moderated, down to 9.4% year-on-year. That's a sharp fall from 20.7% a year ago. And they noted this was primarily driven by slower growth in credit to NBFCs.
Right, and personal loans. That segment's usually strong.
It also slowed down. It registered 13.7% year-on-year growth, which is still decent, but it's down from 19.3% the previous year.
So this widespread deceleration in credit growth across pretty much all major sectors. It does raise an important question, doesn't it? Does this signal a broader cooling of the economy? Or perhaps is it more reflective of a cautious approach from the lenders themselves, maybe becoming more risk-averse?
It's likely a combination of factors.
Yeah.
Slower economic activity could reduce credit demand. At the same time, after a period of rapid growth, lenders might be becoming more selective, perhaps tightening credit standards slightly. The RBI's earlier rate hikes would also have played a role in dampening demand. This data certainly provides context for why the MPC acted as it did in June.
Okay. Next, an update on market timings. This is crucial for liquidity and efficiency in the financial markets. The RBI reviewed recommendations from a working group that looked into trading and settlement timings.
That's right. Back in February 2025, remember they formed that 9-member working group, chaired by Ratha Shyam-Ratho. Its job was to assess the existing market timings and propose changes. The goals was things like enhancing market development, improving price discovery, and optimizing liquidity management.
And the RBI has now approved some of those recommendations.
Yes, they've approved certain recommendations for implementation.
So what are the key changes that market participants need to be aware of? Which markets are affected?
Okay, first, for the call money market. The revised timings are now 9:0000 a.m. to 7:00 p.m. That's a significant extension from the previous 5:00 p.m., and that's effective July 1st, 2025.
7 p.m. for call money. Okay. Does that affect anything else?
Yes, it has a knock-on effect. It means adjustments to the Standing Deposit Facility, SDF, and Marginal Standing Facility, MSF, operational windows. Those will now be available from 7:00 p.m. to 11:59 p.m. instead of starting at 5:30 p.m.
Aligning with the market close.
Exactly. Also effective July 1st. It ensures coherent liquidity management tools are available right after the market closes.
Were there any other market timing changes announced?
Yes. For market repo and tri-party repo, or TRUP, the revised timings there are 9:00 a.m. to 4:00.
4 p.m., that's also an extension.
Yes, extended from 2:30 p.m. for market repo or 3:00 p.m. for TRAP, and that change is effective August 1st, 2025.
Okay. Any market's not changing?
Yes. They specifically noted that timings for the government securities market, the foreign exchange market, and the interest rate derivatives market remain unchanged. They still close at 5:00 p.m.
Interesting. So extended hours for money markets and repos, but not for GSECs or FX. This does raise a question. How will these extended hours impact traders and institutions, thinking about operational efficiency, staffing, maybe even alignment with global market activities?
It's a good question. Longer hours can potentially increase liquidity and allow participants more time to manage their positions, especially aligning better with European hours, perhaps. But it also increases operational demands, longer staffing hours, system availability. The staggered implementation might help institutions adjust. It'll be interesting to see how market dynamics adapt, particularly in the call money market, with that significant 2-hour extension.
Okay, let's turn to data quality now. A critical aspect, really, for financial stability and effective regulation. The RBI has an update on its Supervisory Data Quality Index, the sDQI, for scheduled commercial banks.
Right, the sDQI. This was developed, you recall, to quantitatively measure the quality of the data banks submit to the RBI.
How does it measure quality?
It assesses 4 key dimensions: accuracy, timeliness, completeness, and consistency in the bank's return submissions. And it adheres strictly to the master direction on filing of supervisory returns from 2024.
And it's based on international principles.
Yes, it draws inspiration from Principle 13 of the Basel Committee on Banking Supervision, focusing on supervisory reporting.
Okay. And what's the latest assessment according to this sDQI? Is the quality getting better or worse?
Well, the good news is the sDQI score for scheduled commercial banks has shown improvement in March 2025 compared to the score in March 2024.
That's positive.
It is. The sDQI for SCBs, it covers 87 banks and looks at their key regulatory returns. Things like those on asset liability and off-balance sheet exposures, asset quality reports, operating results data, and capital adequacy returns.
So an upward trend in data quality. That sounds like a very positive sign for both the effectiveness of regulatory oversight and the overall quality and reliability of bank reporting in India.
Definitely. Better data leads to better supervision and ultimately a more stable financial system. It shows the focus on data quality is perhaps yielding results.
Now, for something that could really change the game for fixed income investors and market participants dealing with state government debt, the RBI has officially introduced the facility for stripping and reconstituting state government securities, SGS. This sounds quite technical.
It is a bit technical, but it's important. So let me give you the context. Stripping. It's basically the process of separating the individual cash flows of a government security, meaning you take each coupon payment and the final principal payment and you turn them into distinct, separate securities. Zero coupon bonds, essentially.
Breaking the bond into its pieces.
Exactly. And reconstitution is, just as the name suggests, the reverse process putting those pieces back together to form the original bond.
And this already exists for central government bonds.
Yes. This facility has been operational for central government-dated securities, GSECs, since way back in April 2010.
So the big news is that states can now also utilize this process for their bonds.
Yes. That's the core announcement. The RBI has decided to officially introduce this STRIPS facility, separate trading of registered interest in principal of securities for state government securities, and also securities issued by union territories.
Why do this? What's the benefit?
Well, the move is expected to broaden the array of market instruments available to investors. It should enhance overall liquidity in the state debt market and hopefully improve market efficiency and price discovery for state bonds.
Interesting. What kind of state securities are eligible for this stripping and reconstitution? Are there specific criteria?
Yes, there are. Only fixed coupon securities issued by state governments or union territories are eligible.
Okay, fixed coupon only.
Right. They also must have a residual maturity of up to 14 years. There needs to be a minimum outstanding amount of 1,000 crore on the day of stripping. They have to be eligible for SOR investment, the statutory liquidity ratio, and crucially, they must be transferable, held in demat form. Physical securities are not eligible.
Got it. Quite a few conditions there. How does someone, say, an institution, actually go about requesting either stripping or reconstitution?
Okay, so SGL account holders, those are typically banks and institutions with direct accounts with RBI. They can submit their request directly through the RBI's eCouber system.
Okay.
Gilt account holders think mutual funds, insurance companies who hold securities through a custodian dues. They must route the requests via their custodians who maintain the CSGL accounts with the RBI.
Right. And are there any fees involved for using this STRIPS facility?
No. The RBI has stated it will not levy any fees for stripping or reconstitution.
That's good. Any minimum transaction size?
Yes, the minimum amount of securities required for tender is 1 crore, and then in multiples thereof.
Okay.
And importantly, all the existing provisions from the earlier RBI notifications on central government strips will apply with necessary adjustments to these SGS strips. Also, all the coupon strips that have the same maturity date will share the same ISIN code and will be fungible, meaning they're completely interchangeable.
This really does sound like it could deepen the market for state debt. It raises the question, though, how will introducing strips for state government securities actually impact market liquidity and the pricing for state debt? And maybe more relevant for some listeners, what new investment opportunities might this create for you, the investor?
Well, theoretically, it should improve liquidity because it creates more tailored instruments. Investors who only want exposure to a specific maturity, say a 5-year cash flow, can buy just that strip instead of the whole bond. This could lead to finer pricing along the yield curve for state debt.
So more choice for investors.
Exactly. It allows investors to create zero-coupon bonds synthetically, or to hedge specific interest rate risks, more precisely using these strips derived from state bonds. It essentially allows you to customize your investment in state bonds, like buying individual pieces of a financial puzzle. It could make state debt more attractive to a wider range of investors looking for very specific income streams or duration profiles.
Okay, let's shift now to examine how banks are compensated for handling government transactions. The RBI has revised the agency commission rates for agency banks.
Yes, this is about the plumbing of government finances, really.
Yeah.
Agency banks, they handle various transactions on behalf of central and state governments, collecting taxes, making payments, handling pensions.
Right, essential services.
Absolutely. And they claim and receive commission for doing this work. The RBI pays this agency commission, and the rates are determined by the RBI. It covers revenue receipts, payments, those pension payments, and sometimes other specifically advised tasks.
So what are these new rates, and when do they become effective?
Okay, these new rates are effective from April 1st, 2025. So looking back slightly.
Okay.
For e-mode receipts, so electronic collections, the rate increased from young euro to transaction to 12 per transaction.
They're decent jump.
Yeah.
Yeah.
Pension payments went up from 75 per transaction to 8 euro per transaction.
Okay.
Payments other than pension saw a smaller increase, from 6.5 pays per euro per turnover to 7 pays per euro.
All right. Anything stay the same?
Yes, physical mode receipts like cash or check deposits at the counter, that rate remained unchanged at 44 per transaction.
Interesting. Were there any clarifications on exactly what types of payments are eligible for this commission now?
Yes, they clarified that agency commission will now be payable on all payment transactions, with 2 exceptions.
Which are?
It's not payable if the transaction is pre-funded or if the government already separately compensates the agency bank for that specific work.
Got it. So this basically ensures fair and, importantly, updated compensation for banks providing these essential government services.
Yes.
Keeps the wheels turning smoothly.
Exactly. It reflects the costs involved and ensures banks are adequately remunerated for this critical function in the financial system.
All right, now for a really high-level view of India's external economic health. The RBI has released the data on India's balance of payments, or BOP, for the fiscal year 2024-25.
Yes. The BOP data always gives us that crucial external sector perspective. So for 2024-25, India's current account deficit, the CAD, it stood at US $23.3 billion. That's equivalent to 0.6% of GDP.
0.6% of GDP. How does that compare to the previous year?
It's actually lower. In 2023-24, the CAD was US $26.0 billion, or 0.7% of GDP.
So the deficit narrowed. Why was that?
The primary driver was higher net invisibles receipts.
Invisibles, meaning things like services, exports, and remittances.
Exactly. Higher net receipts from services and also personal transfers like remittances from Indians working abroad were the main contributors.
Okay, that's the positive side on the current account. What about the capital account, foreign investment flows?
That's where the picture's a bit more mixed. Net inflow under foreign direct investment, FDI, they came in at US $1.0 billion in 2024-25.
Only $1 billion. That sounds low.
It is significantly lower compared to the US $10.2 billion recorded in 2023-24.
Wow. And foreign portfolio investment, FPI, flows into stocks and bonds.
Similar story there, though, still positive. FPI recorded a net inflow of US $3.6 billion. But again, that's substantially less than the US $44.1 billion net inflow seen the year before.
Big drop-offs in both FDI and FPI inflows compared to the prior year. What about our foreign exchange reserves? How did they fare during this period based on the BOP?
Well, on a balance of payments basis, which adjusts for valuation changes, there was actually a depletion of US $5.0 billion in the foreign exchange reserves during 2024-25.
A depletion? But reserves went up overall, didn't they?
Yes. That's the difference between the BOP measure and the nominal change. The depletion on a BOP basis contrasts sharply with the large accretion of US $63.7 billion seen in 2023-24.
Okay, so why did the nominal reserves increase if the BOP showed a depletion?
Valuation gains. In nominal terms, the reserves did increase by US $21.9 billion over the year. But, and this is key, this figure included a very substantial valuation gain of US $26.9 billion.
Where did that gain come from?
Mostly reflects the impact of higher global gold prices and lower global bond yields during that period, which increased the dollar value of India's gold and foreign currency assets.
Right, so taking valuation out, the underlying flow is negative. That paints a more nuanced picture. We have a shrinking current account deficit, which is good, but also a notable slowdown in key capital inflows like FDI and FPI. And the reserves increase was largely due to these valuation effects. It prompts the question, What do these shifts in capital flows really tell us about global investor sentiment and confidence towards India right now?
It suggests perhaps a more cautious global environment, or maybe investors took some profits after the large inflows the previous year. The lower CAD is definitely a positive, showing resilience in services and remittances. But the slowdown in FDI and FPI warrants watching. It could reflect global risk aversion, specific domestic factors, or just normalization after a very strong prior year. The valuation gains masking an underlying outflow in reserves also highlights the impact of global financial conditions.
Okay, closely related to our external financial position, let's look at India's external debt figures as of the end of March 2025.
Right, the external debt stock. So at the end of March 2025, India's total external debt stood at US $736.3 billion.
$736.3 billion. How does that compare to the previous year?
It's an increase of US $67.5 billion over the end of March 2024.
Okay. And what about the debt relative to the size of the economy, the debt to GDP ratio?
That also increased slightly. The external debt to GDP ratio went up to 19.1% compared to 18.5% a year earlier.
Did currency fluctuations play a role in that increase? The dollar was quite strong.
Yes, they did. The appreciation of the US dollar against the Indian rupee and other currencies resulted in a valuation effect. They estimated this valuation effect accounted for US $5.3 billion of the increase.
If you exclude that valuation impact.
Then the debt would have increased by a slightly larger US $72.9 billion based on actual transactions.
Okay. What about the composition of this debt? Is it mostly long-term or short-term debt?
The majority is long-term. Long-term debt stood at US $601.9 billion, and that increased by US $60.6 billion over the year.
And short-term debt?
The share of short-term debt, defined by original maturity of up to 1 year, and the total external debt actually declined slightly to 18.3% from 19.1%.
Okay, but are there other ways to look at short-term risk?
Yes. Importantly, the ratio of short-term debt by original maturity to foreign exchange reserves increased to 20.1%. And if you look at short-term debt on a residual maturity basis, meaning debt maturing within the next year, regardless of original term, that constituted 41.2% of total external debt and significantly 45.4% of foreign exchange reserves.
Right. That residual maturity figure is often watched closely. What's the currency breakdown of this debt? Is it mostly dollars? And which sectors hold the largest share?
U.S. dollar-denominated debt remains the largest component, yes. It accounts for 54.2% of the total. That's followed by debt denominated in the Indian rupee at 31.1%.
Okay. And who owes the debt? Government.
Corporates.
Both government and non-government sector debt increased during the year. Looking at the breakdown by borrower type, non-financial corporations hold the highest share of the outstanding debt at 35.5%.
Right.
They're followed by deposit-taking corporations, basically banks, at 27.5%. And then the general government at 22.9%.
And in terms of instruments, is it mostly loans? Yes. Loans remain the largest component of external debt, making up 34.0% of the total.
Okay, and one final crucial metric. How does India's debt service ratio look? Our ability to actually pay the interest and principal.
That remained quite stable, actually. Debt service, which includes both principal repayments and interest payments falling due during the year, it marginally declined to 6.6% of current receipts exports plus invisibles at the end of March 2025. That's slightly down from 6.7% a year prior.
So even though the total external debt is growing, the fact that the debt service ratio is stable and relatively low suggests resilience. What implications does this hold for India's overall creditworthiness and its ability to attract foreign capital in the long run?
It's a key point of comfort. While the absolute debt levels has risen, the manageable debt service ratio indicates that India's capacity to meet its external obligations remains strong. This is a positive signal for international investors and credit rating agencies. It suggests that the current level and growth rate of external debt are sustainable within the context of India's foreign exchange earnings. Maintaining this manageable ratio is crucial for sustaining confidence and attracting capital.
Right. Our final deep dive for June brings us to new, quite comprehensive directions from the RBI on lending against gold and silver collateral. This is something that directly impacts a very common form of borrowing for many households.
Absolutely. Gold loans are a huge market. So for background, the RBI had generally restricted lending against, primary gold like bullion or bars. That's due to macro-prudential concerns, worries about speculation.
Right.
However, regulated entities, banks, NBFCs, co-op banks, they were permitted to lend against gold jewelry, ornaments, and even gold coins, typically for short-term financing needs.
So what's the purpose of these new directions? Are they changing the rules significantly?
The main goal seems to be to consolidate and harmonize the regulations across all these different types of regulated entities,
Okay,
RMI,
so everyone follows the same rules.
pretty much. They aim to put in place a single, harmonized regulatory framework applicable across commercial banks, cooperative banks, and NBFCs. They also want to address certain concerns they've observed in some lending practices in this space
Okay.
and provide much-needed clarity on certain aspects and, importantly, strengthen the conduct-related dimensions, how lenders interact with borrowers.
When do these new rules kick in?
These new directions become effective from April 1st, 2026, so there's some lead time. But any pre-existing loans taken before that date will continue to be governed by the earlier regulations they were booked under.
Okay, April 2026. What specific types of loans are covered by these new harmonized guidelines?
Okay, the loans must be for either consumption purposes or for income generation. That's specified.
Right.
And they must be backed by gold or silver jewelry, ornaments, or coins.
What's not eligible as collateral?
Importantly, primary gold or silver like bullion, bars, and also gold or silver-backed financial instruments like exchange-traded funds, ETFs,
Right.
are explicitly not eligible collateral under these new rules. It has to be physical jewelry, ornaments, or coins.
Got it. What about loan to value, the LTV norms? How much can you borrow against the value of your gold or silver?
Okay, this is now standardized and tiered based on loan size, specifically for consumption loans. The maximum LTV ratio varies. It's 85% for loans up to 2.5 lakh.
85%.
Then it drops to 80% for loans between 2.5 lakh and 5 lakh.
Okay.
And it's 75% for loans above 5 lakh.
Tiered LTVs. And does that LTV have to be maintained?
Yes. Crucially, this LTV ratio must be maintained throughout the entire loan tenure. So if gold prices fall significantly, the borrower might need to provide more collateral or repay part of the loan. And for bullet repayment loans, where you pay everything back at the end, the LTV calculation has to include the total amount repayable at maturity, including accrued interest.
Okay. Are there limits now on the quantity of gold or silver that can be pledged?
Yes, they've introduced quantity limits per borrower, per lender. It's a maximum of 1 kilogram for gold ornaments, 10 kilograms for silver ornaments, 50 grams for gold coins, and 500 grams for silver coins.
Quantity caps, too. How will the valuation of the collateral work under these new directions? How do they determine the V in LTV?
The valuation must be based purely on the intrinsic value of the gold or silver content. That means excluding the value of any embedded precious stones or jewelry craftsmanship value.
Just the metal value.
Exactly. And the price used for valuation should be the lower of either the 30-day average closing price or the previous day's closing price.
Lower of the two. Where do they get these prices from?
From reputable sources like the India Bullion and Jewelers Association, LTD, IBJA, or SEBI-regulated commodity exchanges. What's really fascinating here, I think, is the strong emphasis throughout these directions on conduct and transparency. It seems to be a major focus.
In what ways?
Well, for instance, loans above 2.5 lakh will now require a detailed credit assessment of the borrower. It's not just about the collateral value.
Yeah.
Standardized assaying, testing the purity of the gold or silver, must be conducted in the borrower's presence, and there must be proper documentation of that process.
Transparency in testing.
Yes, and loan agreements, key documents, all communications, they must be provided in the regional language or the borrower's preferred language. And importantly, if the borrower is illiterate, a non-employee witness must be present during the process.
That provides significant protection. What about the auction procedures if, unfortunately, a loan isn't repaid? How are those being standardized to protect the borrower?
Right. Auctions are a sensitive area.
Yeah.
The directions mandate a clear and transparent auction policy.
What does that involve?
It includes providing adequate notice to the borrower, or their legal heirs if necessary. Setting a reserve price, which must be at least 90% of the current assessed value of the collateral.
90% reserve price.
Yes. Though this can be reduced to 85% after 2 consecutive failed auctions.
Okay. Where do these auctions happen?
The first auction attempt must take place in the same district where the loan was granted. Subsequent auctions can be held online or in an adjoining district if the first one fails.
And who can bid?
Crucially, the lender itself or any of its related parties are strictly barred from participating in these auctions. This prevents potential conflicts of interest.
That seems fair. What happens if the collateral is lost while in the lender's custody? Or if there are delays in releasing it back to the borrower after they've repaid the loan?
Good questions. The directions are clear here, too. Collateral must be securely stored in the lender's branch vaults. There need to be periodic surprise verifications and internal audits of this storage.
And release after repayment.
The collateral must be released within 7 working days following full repayment of the loan.
7 days. What if there's a delay?
If there's a delay that's attributable to the lender beyond those 7 working days, they have to pay compensation to the borrower. $5,000 per day of delay.
Wow, $5,000 a day. That's a strong incentive.
It certainly is. Fair compensation for any loss or damage to the collateral while in custody is also explicitly mandated. And finally, there are some very clear restrictions outlined to prevent potential misuse or poor practices.
Such as?
No repledging of the gold or silver collateral by the lender. No cross-lending against it. Loan disbursements and repayments must strictly avoid going through third-party accounts. If a lender grants multiple loans to the same borrower against gold-silver, it requires stricter internal audit checks.
Right.
Any unclaimed collateral that remains beyond 2 years after the loan is fully repaid needs to be specifically flagged, with half-yearly reports on such cases going to the lender's board. And lenders are also required to disclose, in their financial statements, the percentage and total amount of loans they've given against gold and silver, separating them out for consumption versus income-generating purposes. More transparency.
So this really is a comprehensive, top-to-bottom set of rules designed clearly to protect consumers and standardize practices across the board in what is a very significant lending segment in India. It certainly raises a final important question for our listeners. How will these quite stringent new guidelines impact the actual accessibility and maybe the cost of gold loans for the average borrower come April 2026? And ultimately, will they lead to a more formalized, transparent, and secure process for you, the individual consumer, when you approach this type of borrowing? It's the key question. Stricter rules on valuation, LTV, auction processes, and conduct could potentially increase operational costs for some lenders, which might be passed on. However, the increased transparency, standardization, and consumer protection measures could also boost borrower confidence and make the formal sector gold loan market more attractive compared to informal lenders. It aims for a safer, fairer market, but the impact on accessibility and costs will be something to watch closely as we approach 2026.
Wow, what a journey that was through the RBI's news tab for June 2025. I mean, from those major monetary policy shifts clearly aimed at boosting growth while keeping an eye on inflation.
Yeah, the rate cut, the CRR cut.
Exactly, to all that fine-tuning of regulations for microfinance, the UCBs, large exposures. It's abundantly clear the RBI is constantly actively calibrating India's very intricate financial system.
Absolutely. And we also saw those significant efforts to enhance market efficiency with the revised trading timings, the focus on improving crucial supervisory data quality.
Introducing innovative instruments like strips for state government securities, which can be quite transformative. And importantly, bolstering consumer protection in key areas like reclaiming unclaimed deposits and making the gold loan market safer and more transparent.
Right.
Even the external sector data, while showing some shifts in capital flows, ultimately paints a picture of a dynamic and adaptable economy navigating global cross-currents.
You, our listener, have now gained, I hope, an incredibly detailed and nuanced understanding of these crucial developments from just 1 month of RBI activity. And these aren't just abstract headlines, are they? They are direct indicators of the economic pulse and the regulatory environment that genuinely shape financial decisions at every single level, from large corporations right down to your personal finances.
It's truly insightful, isn't it, to see how interconnected all these seemingly disparate announcements actually are. They don't really operate in silos. You can see them forming a cohesive strategy aimed at fostering stability, driving growth, and ensuring efficiency across the entire Indian financial landscape.
So as you reflect on all these insights from June 2025, maybe consider this final thought. How might these wide-ranging regulatory adjustments and the economic signals we've discussed influence the financial landscape over the rest of 2025 and beyond? And perhaps more practically, what new opportunities or indeed challenges might they present for your own investments, your borrowings, and your overall financial planning going forward?
Food for thought.
We certainly hope this deep dive helps you navigate it all with a bit more confidence.